Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, I'm just going to go over some of the things that are happening right now in the market. And before I get into the video, I just want to say Eid Mubarak if you are celebrating Eid, either tomorrow or next day, whenever it is, InshaAllah. Eid Mubarak to you and your family. I hope you're having a great day, or great days if you celebrate 2-3 days, InshaAllah. One of the things that happened yesterday was in the market. I was out the whole day yesterday and I had a chance to look at the market last night. And when I looked at it, I was like, whoa, something crazy must have happened for the market to crash this much, okay? I think the S&P 500 was down 3%, the Nasdaq was like 4-5%, the Dow was down, everything, right? And I thought, okay, let me just read about the news. Has something happened? Is it something to do with another COVID lockdown or whatever the case might be? And it wasn't. It was just more to do with Amazon missing their earnings report, Apple not doing great and talking about supply chain things happening. So it wasn't a lot of things. There are a lot of negative out there. The Fed hasn't said anything. So it was just crazy. And the market right now, it just seems really crazy. There's no other way to describe it, because it's normally what drives the market is the microeconomy. Okay, so the macroeconomy is basically what's happening in the world, what is happening to economics everywhere, GDP, employment, and all of that crazy stuff, right? None of that is, well, some of it is bad, but none of it is like news. Okay, it's not something that we haven't digested already. We knew about this. The investors are already aware of all of these things. So it's just frustrating because let me show you my portfolio, right? So a couple of days ago, I was celebrating the fact that my portfolio has reached £50,000. I think it was just at some point last week. There we go. Thursday, in fact, on 28th. 2 days later, it is 29,000. Now, it does happen. These things do happen. And I'm not really, like I've always said, I'm not really too concerned about that. And we will talk about that now. So when something like this happens, you need to step back and think about your strategy. First of all, do you actually have a strategy that's going to work for you? That's gonna, at least do you have a plan of action when something like this, for example, happens? Because if Microsoft is down 4%, right, you think something has happened to the company. But when you look at their earnings report, they beat across the board, okay? And the stock was up 3%, 4% on that day. In fact, it was about 6%. At the end of that day, maybe 4-5%. Their earnings report was absolutely amazing in every single angle you look at. And I've listened to the call and it was really good. Positive, a lot of new things, okay? Excitement, everything that is you expect from them. Qualcomm was down yesterday, let me show you, 5.74%. Now, Qualcomm was another company that had a beat all around, okay? Revenue, 41% up from obviously Android phones and so on. Now, when you check this kind of thing and you realize what is happening, so why are these companies, even though they're quality companies, why are they down? It's because people are fearful. People are selling because they're worried. Because they're worried there might be a crash and so on. So what we now need to talk about is basically some of the strategies that I'm using and some of the strategies that you could potentially use to kind of stop yourself from selling your stocks. And it's really important that you don't panic sell. So let's talk about that. Right, the first thing I want to talk about is when something like this happens, or even the market goes down 10%, 15%, whatever it is, in maybe 2 days, 3 days, 4 days, okay? Absolutely do nothing. Okay, I'll tell you some of the things that you can do, but what you cannot do is sell your stocks. Because generally, okay, in the long run, stocks do go up. So even if you just look at my portfolio, although I've been adding money to it, okay, generally stocks go up, and I'll prove it to you. Just look at Microsoft. Someone bought it when in 1989, when it was about less than $1. Okay, that person is probably right now retired, a billionaire, whatever. Okay, and when you look at it generally, the stocks always go up. Yes, there might be a crash here and there. So in 2020, what's happened? Look how small that is. Okay, it went down 25 to almost 26% on the 14th of February. 26%, right? But then what happened after that? From that bottom to where it is right now is 102%. Not every single company will do this, but there's always some sort of uptrend going on. And that's the thing that you need to focus on as an investor. And if your time horizon is just 5 years, that's what can happen in 5 years. Okay, if you're thinking about long run, say 20 years, 30 years, this is what might happen. That's if you buy the right companies, and we'll talk about that in a second. Not every company will have this. Okay, look at this company. Look at this one. Just this year, okay, it's down 80%. Right? I'm not saying this company is not a quality company. What I'm saying is a very new company, is still in the early stage. Okay, it's not a mature company yet. So they're burning a lot of cash. Whatever comes into their pocket, they're using that. They're also borrowing money from the bank. They are in debt. They're not making any money. They might be in debt, actually, I'm not sure, but they are not making any money. They're not profitable yet. And for that reason, investors will panic sell because they're like, oh, I'm worried about what might happen to the company. So boom, straight away sell. Right. This company might have a future. Everyone says, okay, because of COVID, they're around because of COVID, because, people couldn't go to their doctors. So they actually had a Zoom call with their doctor. Okay. They're using their teledoc platform to actually meet with their doctor or another doctor, whatever the case might be. But that potentially this company might be around for another 100 years. But right now, it's still early days. And to be honest with you, this company should be around this much right now. It should never have gone up to, $171 per share. Because the valuations doesn't add up. And this is the kind of thing about buying companies that are up and coming. If you are willing to hold for another 10, 15 years, right, that's fine. If you own the stock and you're willing to hold it for another 10 years, absolutely fine, credit to you. Okay, but that's the kind of thing you need to think about. So when the stock market goes down 20, 30%, the first thing you need to think about is, okay, I really don't need to do anything. And if you're going to do anything, I want you to do step 2, and that is go shopping. Look for companies, quality businesses, right? Like the Microsoft, like the Qualcomms, like MasterCard, the Visas, Johnson & Johnson, companies that have been around for a long time. The Home Depots, the Lowe's. I'm not saying the companies, it looks like I'm naming the companies that I own, but I'm just saying, okay, there's so many stocks out there. Look at every single sector, pick the 5 best companies in that, the top 5, and maybe invest in them. If it fits into, if it's Sharia compliant and that's basically something you need to look into, then do that. Find out whether they're compliant, then buy those companies when they're basically under, pressure, right? That is the first thing you should start doing. So first thing is don't do anything. And if you're going to do anything on that day when the stocks are crashing, right, then put some money to work. Because in about 10, 15 years, that would not matter. Trust me. There were people that bought Microsoft on the day it crashed. Okay, on that day, let me quickly show you if I can find that. So on that day when the markets were crashing, right? So about 5 years ago, let's go back here. On that day, on that 14th of February, right? When the markets bottom, and 20th of February. If you bought 20th of March, 2020, if you bought Microsoft, you would have actually made 100% right now. And that's just a space of what? 2 years? Okay? 2-3 years, whatever, just think about that. Just think about the long-term plan. And that is all I'm saying. So if you're doing anything, buy quality companies. When you're buying companies, okay, in my opinion, don't just put, 2,000, 3,000 into one stock or whatever. Dollar cost average. There's advantage for dollar cost averaging, okay? It's the safest way to go and basically buying, undervalued stocks. Dollar cost averaging smooths out the ups and downs of your average basically purchases, and that's really important. Okay, so one day you might be up and the next day you might be down. So when you buy it when it was up and then you buy it when it was really down, it kind of averages it out. Okay, so it actually is there's advantage to doing dollar cost averaging. Although some people argue it lump sum is actually easier and sometimes is better. Okay, in my opinion, I will dollar cost average, and that's what I do every single week. I put at least 250,000, I wish, 250 pounds into the stock market. Some weeks is actually slightly more. If I see something that I like and a company that have been on my radar, I've got a little bit of cash lying around, definitely buy a bit more. So dollar cost average is actually a nice way of basically kind of diversifying and at the same time, smoothing out that ups and downs, if you like. The next thing I would say is, for me, number 4 will be hunt for dividend stocks. Dividend stocks are really great when they're bear markets. Bear market is basically you're not making any money on capital appreciation. The companies like Adobe, for example, are not going to, although right now we're down, okay, it might be down for another 2 years, 3 years, okay, and that's dead money sitting there. So I'm not really getting anything out of this business right now as we speak. But on the other hand, air products and chemicals are paying me dividends. So if I show you right now, okay, when this loads up, okay, I'm buying more, but I'm getting about £10. Okay, that's £10 that I didn't have. That's £10 that I'm not getting from Adobe, for example. In the long run, Adobe might do better, okay, if it bounces back, blah, blah, blah. But air products and chemicals could do the same. But I'm still getting paid. And the more I buy, the more dividends I get, the more dividends that they pay me, the more I buy into these companies. And that is the importance part of the compounding effect. Same goes for all the other companies in my portfolio. So dividend stocks are really great when it comes to bear markets. And a bear market can be 20% or more. So that, like when the market goes down 20% or more. Let's have a quick look where the S&P 500 is right now. Right now, we're down 13%, almost 14%. And when we look at the Dow Jones, for example, it's down about 10%. Now, Dow Jones has quality companies that have a loads of free cash flow and so on. So they tend to be less volatile than the entire S&P 500 or the Nasdaq, for example. The Nasdaq, for example, the QQQ that tracks this, is actually down about 22% right now. Just yesterday, okay, just basically 5 days, the last 5 days is down about 3%. Okay, and then yesterday was actually almost a 5% down. Right, so when something like this happens, okay, you just don't need to panic and watch the news and what's happening and the panic and the news. Everyone's talking about, oh, the Dow Jones is down 500 points, 700 points, 800 points. None of that matters. What matters is, do you actually have quality businesses in your portfolio that you can rely on? You know they're going to be around for a long time. They have a free cash flow here that they can actually reinvest in the business or pay you as a dividend or acquire new businesses or so on. Whatever the case might be, you need to look at your portfolio and say, okay, what is it that in my business, what do I have in my portfolio, and what's my goal? Right now, if you ask me, my goal is to basically have at least 30 to 40 different companies in my portfolio that quality, have a free cash flow, have a moat, and so on. And if they don't have these qualities, some companies will be, obviously, I might have one or two that do not meet that criteria, okay? But they might actually pay good dividend, and I might have like a 2-year time horizon for them and then get rid of them in 2 years' time, whatever the case might be. But as long as you know these companies, one of those companies is Rio Tinto. Rio Tinto, I don't think is sitting here for the price appreciation, okay? They pay really good dividend, and I'll be honest with you, actually a couple of days ago, I got paid, 18, almost 20 something pounds just to buy this company. I think I had 6 shares at the time, and I bought 2 shares. So I took that money, added a little bit I had, okay, and I bought 2 more shares of that. So there are some companies in here that you think, okay, maybe in the long run I might get rid of them, but for now they're actually paying me some good dividend, and I want to keep them. So every single investor I read a lot of books, and I always talk about this, right? Every single investor that I've basically, every investment book that I've read, from Warren Buffett, I've read about 2-3 books of his, okay? From Benjamin Graham, the intelligent investor, from Peter Lynch, and everyone else. Everybody says the same thing. Do not panic sell. Buy quality companies that have a great moat. Okay, know what you own and forget it. Keep investing. For example, the days that you have a down days, whatever, if you've got extra cash lying around, your time horizon is say 7, I don't know, 10 years, 15 years, 20 years, whatever, okay, then buy those quality companies. If Johnson & Johnson goes down 10, 20% right now, I will look I'll find every cash in my bank and I'll put it in there. Not straight away, but I will dollar cost average into that, okay? And why? Because I know maybe 20 years from now, 10 years from now, what's happening right now wouldn't matter. And the stock price will go up eventually. It will bounce back. Because if you look at these kind of companies from early on, so for example, since 2013, this stock was $86 per share. If you bought it at that time, right now, you would have £100 per every single share you own, just below $100, sorry. So this is the thing that I really want you to start thinking about. Don't panic sell. Read about great books, learn about investing in general and how to not get into the panic mode and sell everything you own because everybody else in CNBC is panicking and saying, oh, it's down 20%. None of that matters, okay? And final thing I want to say is one of the best way to own, basically to know whether you own a good business or not is, first of all, know the companies that you own, and secondly, read their earnings report. Right now, as soon as this video is over, what I'm reading is Stanley Black & Decker's latest earnings report. The stock went down straight after this happened. So I want to find out exactly what's going on in this business. I hope you enjoyed the video. If you like this kind of video, please like, subscribe to the channel. Assalamu Alaikum.